Japanese stocks rose sharply on Tuesday as trading in the country's exchanges resumed after a holiday, leading gains in the region. The benchmark Nikkei 225 jumped more than 3% to reach over 36,000, while the broader Topix gained 2.4%. The momentum was largely driven by tech and finance stocks. Meanwhile, South Korea's Kospi dipped 0.17%, while the small-cap Kosdaq lost 1.58%. Hong Kong's Seng gained 0.1%, and mainland China's CSI 300 slid by around 0.2%. Australia's S&P ASX 200 climbed 0.1% as wages in the country rose 0.8%, the slowest pace since the same quarter a year earlier. Traders now await Wednesday's US Consumer Price Index for July, a key indicator of the health of the economy. Let's get more on this now with Jamil Ahmed in Dubai. He's Chief Analyst at GTC Group. Good to have you back on the programme, Jamil. Now, we're seeing Japanese stocks recover after that sharp sell-off last week. What's eased investors' concerns?
Well, a week is a long time in financial markets, but I can't say that all the smoke is necessarily clear following what was that historic volatility just last Monday. You look at the Japanese market recovery, and actually it's been led by yen weakness. That means the Japanese currency is weakening once again. If you look at the USD JPY, that's the dollar yen, actually is gradually returning back towards that sensitive 150 handle. And one of the correlations, the relationships we've had in financial markets for a long time, is that when the Japanese currency weakens, the Japanese stock market, particularly the Nikkei, strengthens, and vice versa. So some of these gains we're actually seeing in Japanese markets today and over recent sessions is actually based on return in Japanese yen weakness. Because again, if you look at the Japanese currency, it was trading as low as 141 against the US dollar during that peak of the market chaos last week, and then it's returned all the way back towards the higher 140s. So we still have some risk ahead. But I do think that that was just an excessive correction that took place in financial markets. But again, we never say never. So we still have to watch out for potential Japanese yen contagion risks.
Right, now investors have turned their focus to US inflation data that's coming out later this week. What's the current outlook, and could it trigger another sell-off?
There's potential, because you could have a situation where the market is by the rumor, which is the rumor that central banks worldwide are going to start cutting interest rates, but selling the fact when the central banks do start cutting interest rates. For example, US Federal Reserve, that's the US central bank, are finally expected to pull the trigger on lower interest rates next month in September. What we're looking out for in this inflation data is actually more impetus and more signs that inflation is slowing in the United States. I like to use a lot of metaphors, and what we've seen so far, it's like a weight loss journey. We had inflation that was at 9%, which is very much overweight. Some would say obesity. Has come back down towards 3%, and it's stagnated around there, so like a weight loss plateau. Now, the central bank target is actually 2%. So we do still need to see inflation trend towards that 2% target, like it's doing in Europe with the European Central Bank and the United Kingdom for the Bank of England, for us to be very excited about the Federal Reserve really cutting US interest rates. But what's helping that argument is that we do have signals of US economic data slowing. So I would also look out for that potential retail sales report and what those figures might be towards the end of this week as well.
Right, now markets both in Asia and Europe are still quite choppy. Why are investors moving so cautiously at the moment?
We have a financial market that performed absolutely superbly over the first half of 2024. Just to give you the S&P 500, which is the major US stock market index, it hit more than 30 record highs in the first half of the year. So on one side, we do have a financial market that's looking very much overweight. Some fundamentals, as well as central banks easing policy, cutting interest rates, does support the narrative. But we cannot ignore or afford to ignore external forces, whether that's the intense geopolitical tensions across different regions of the globe. We also have a US presidential elections taking place in just 3 months' time. Nobody knows what 2025 might bring. So that might be why investors are looking for a little bit of clarity, or potentially they're a little bit more cautious that the market cannot go that much higher unless we have some really significant catalyst that pushes in that direction.